understanding the risk-return trade-off in mutual fund investing. Hey everyone, welcome back. In today's video, we'll talk about an important concept in investing, the risk-return trade-off. Specifically, how it applies to mutual fund investing. Understanding this balance can help you make more informed decisions about where to invest. Let's break it down. What is the risk-return trade-off? First, let's define the risk-return trade-off. This principle suggests that the potential return on an investment increases with the level of risk you're willing or able to take on. In simpler terms, if you want higher returns, you might have to accept a higher level of risk. When it comes to mutual funds, this trade-off is something every investor should be aware of. Different types of mutual funds come with different levels of risk, and understanding that risk can help you select funds that align with your financial goals. Risk in mutual funds. Risk in mutual funds can come in many forms. Some common types include market risk, interest rate risk, and credit risk. For example, equity funds. Those that invest in stocks tend to have a higher risk because the stock prices can fluctuate widely. On the other hand, bond funds are usually less volatile, but they come with their own set of risks, like changes in interest rates. The key thing to remember is that the more volatile or uncertain the asset, the higher the risk involved. And generally, the more risk you are taking, the more you stand to gain or lose over time. Return in mutual funds. Now, let's talk about return. Return is essentially the profit or loss you make from an investment, and it's often measured as a percentage of the initial investment. Mutual funds, depending on their focus, can offer different types of returns. Equity funds have the potential for relatively better returns because of their exposure to stocks, but they also come with a higher chance of loss. Fixed income funds such as bond funds might offer more stability but usually deliver lower returns. The goal is to find a balanced mix of risk and return that suits your personal investment strategy. Balancing risk and return. The key to successful mutual fund investing is balancing risk and return according to your financial goals and risk tolerance. If you are young and investing for the long term, you might be comfortable with taking more risk for potentially higher returns. But if you're nearing retirement, you might prefer a more conservative approach with a lower risk and steadier returns. Conclusion. In the end, understanding the risk-return trade-off is critical to building a mutual fund portfolio that works for you. Assess your goals, your risk tolerance, and choose your funds accordingly. If you found this video helpful, don't forget to like, comment, and subscribe for more insights. Thanks for watching. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.